Today's session, we'll be looking at screening due diligence and evaluating impact, and just building on some of the lessons we learned in the last session on red and yellow flags. And you'll see some of those mentioned here, and they're really part as well of the due diligence. Remember, from previous sessions, we've said that as an angel investor, you're really looking to say your first initial position is no, and should be looking to say, why should I not make this investment? And it's up to the opportunity, the entrepreneur, and the evidence they provide to turn that opinion and get you to the point where you're saying, okay, yes, I want to consider this investment. So what are some of the things you look at and what guides you? Well, it's hard to predict with certainty whether a business is going to be successful or not. All you can do is try and reduce the probability as much as possible that it is going to be a failure. And success really for a lot of these businesses you'll be looking at to invest in over the years will boil down to things like, yes, timing, luck, team, and we're saying everything else. And we saw when we're looking at the questions you want to ask around timing is now the right time for this opportunity? What have the stars aligned in terms of luck for this opportunity? Is this the right team to execute on this opportunity? What else might be happening? And I'll give an example. I am currently in the UK and I've been investing on, I look at opportunities on seeders that I put money in. And about 2 years ago, I invested in another opportunity that was playing on the trend around gaming. Fantasy football was a thing, so I took a punt on it. And it was one of the best performers in the portfolio. And then I think recently, maybe about a month ago, it went under because, I don't know, I'm yet to scrutinize why they went under. But really, when I look back at that investment and that time, it was the time when everyone's excited about sports, gaming, and people are getting into fantasy football, and the sky was the limit on what they could achieve. And then 2 years down the road, I don't know, everything else has happened. The pandemic has happened. I don't know what else is happening with the company itself, but that investment that was so good and was driving most of the investment, the return in the portfolio I have, has then turned around and is failing. But yes, you can't predict everything, but you want to reduce the errors and the reasons why you're saying no for an investment. So you scrutinize on these metrics here. And usually when you're looking to make an investment, the kind of information you glean to make that decision and that guides your due diligence will be summarized, as it were, in the business plan. And the business plan, like we did when we're deconstructing a pitch, when you're looking at a business plan, there are certain things you want to see. And if someone has written a decent pitch, then it is usually a summary of their business plan or longer information memorandum for the business. And in there, you'd expect that they'll cover certain aspects of the business. And just looking through this checklist we have here, you want to understand for the business, first of all, the business exists to solve a problem. Does that problem match the solution? And we always say that we want to be solving a problem for a large enough market. So you're looking then at that solution they've done compared to the scale of the problem itself, and do those two align? One of the portfolio companies we invested in and that we pitched at Kane to get funding after it had gotten funding from the 97 fund, which I oversee, was solving the problem around finding substitutes for protein feed, for protein inputs for animal feeds. And they were going about it in what we thought was a clever way. They were finding alternatives for protein, which is usually silverfish, which is becoming expensive with the impact on the environment and and reduction in fishing stocks from overfishing, and with lots of people stopping to live in fishing communities. So they had come up with a solution to that problem by coming up with protein feed substitute through larvae from black soldier fly. And we thought that that was genius. And when we were looking at the market, when they showed us the numbers for the market for protein feed as a supplement, protein supplements for animal feed, it was really a large market. And the way they were going about it, you could see sustainability. So right there, you could see a problem well defined, a solution that aligns and ticks certain boxes, especially if you think about sustainability, and this before you go into the types of jobs they are creating with the business model they had. So when you understand the problem and the scale of the solution to match the problem, you then need to look further at the solution and see, do we understand how it works? And do we understand why customers would buy it? So if we're sticking with the example I just gave, we could see that, and in the room when they were pitching to the angel network, one of the angels we're working with, who's a local business angel, also owns a poultry feed business. And so since he sells poultry feed, you could see already it was aligning, and he was already a customer who would buy this. And actually immediately after that pitch day, he asked to get in touch so he could go and do further due diligence on the business. So then next you understand, do I understand, you want to question, do you understand how the company makes money? Because it's important that you're not going to be investing into a business, and COVID-19 has made that even more important now. You're not going to be investing in a business that is going to be relying on raising funding rounds to justify its valuation, but actually has a business model that generates revenue, that creates some value for society and its shareholders. So it's important to understand how the business is going to monetize or make money. And this gets reflected then into the financial model. Now, for some of the businesses you'll be meeting and investing in, they may have a track record of maybe 1-2 years. Some may have maybe 3-4 years, and you'll have some historical numbers. But it's important to look at the historical numbers and understand why they look the way they look and what they mean for future projections. Yes. And for some of these businesses, especially if it is, say, it may be a technology business, and I speak because I have had the experience of starting and angel investing in a fintech e-commerce type business. In that type of business, you have a portal in the back end where you can see things like transactions and can see the way the business makes revenue. So you want to look at the numbers behind what has been presented historically, and then see how the projections are being made and how that is built up, linking to the business model. So you're peeling back layers, and layers, and then it's not just about financial returns. You then want to look at impact as well. And Rachel will share later about how you assess for impact. So the other aspects then of the business plan, that if you like was looking more inward. The part one. This part two now looks more outward. So you just want to understand, okay, who else is doing this in the economy? Do they have competition? And remember, one of the red flags we mentioned last week was, if you have a company that says they do not have competition, then they've not researched their market too well, or you probably want to tell them to walk out of the room and just come back with something more realistic, or they've not thought through their business to understand clearly all aspects of it, and therefore be able to size up and identify which other competition is out there. And so you're asking that about, you want to scrutinize that about the business. Then you want to look then at for that competition and that market they're in, how big is that opportunity, and is it large enough that even if they were not winner takes all, there'd still be a business that can give you decent returns. And we all know the example, for example, of Lyft, which people may relate to, compared to say Uber. And when I was reading about Lyft, anecdotally, the idea about the concept being born out of one of the founders seeing this model on the continent. I think in Zimbabwe it was, and going and trying it out in the US, where customers were more likely to pay for it. But then even when Uber came along later, the market was still large enough that both businesses have been able to go to the exchange. So when you bring it down to some of the opportunities you're looking at in our markets as well, you just want to see that that opportunity is big enough to be pursued. And again, you build it up with the numbers. You then want to scrutinize as well what the cost of acquiring customers are, and related to that maybe is another term you'll hear around lifetime value. But how much does it cost to acquire a customer, and how has this been calculated? And then more practical things around how long does the process take to acquire a customer, and can you see over time whether this has been shortening? Because there'll be lessons that entrepreneurs learn as they get better. They tell you, the mantra always is do the things that don't scale fast, and just learn the process of how you acquire customers, why they buy from you, which is the easier way to do it. But as you get better with time, you should be able to shorten the process by which you get customers on board and bring down the costs, either through working with partnerships, or through innovation in your product and how you go to market, or through innovation in your business model. And you have maybe an acquisition cost, but you make that back through customers paying for your products over time. So you want to scrutinize that as well at the due diligence stage. And then in the last part of the business plan, you're looking at the ask. Remember, one of the red flags or yellow flags we mentioned was around whether businesses are asking for too much or too little. So you need to be able to gauge and look at the ask and see how it matches the size of the company. There's usually, and we can share this data, but I know in one of the other startups I'm involved in called Digest Africa, I'm able to see what the average size or the median size of a deal is in terms of if you're investing at, say, seed stage, pre-seed stage, angel rounds, Series A, Series B, and this varies by sector on the continent. You can get this data, I'm sure, for other parts of the world, but now there's increasingly more and more data if you're doing this on the continent in Africa, and you'll be able to see that. So you can start to gauge. I know by the time companies get to raise Series A, most of them have been able to spend under you could say under 300,000. But again, you need to check the industry. You may spend a little bit more for a fintech. You may spend, or you may spend a little bit more even for e-commerce. You may spend a little bit less for another business that might not be as maybe hardware intensive. So you just need to check and make sure that this makes sense. In parallel to that, then, what are the milestones that will be achieved with the ask? So do they look realistic? And are they creating the value? Because as an angel investor, what you're interested in is because you're investing very early, it is high risk. The benefit of investing at a very early stage as well is that you generate value so quickly. So the value, the growth in value of the business over the first 1, 2, 3 years compared to a later 4th, 5th year, the rate at which value is accrued and gets created is much, much faster in the beginning, and that may slow down as the business becomes more mature. So you want to look at the milestones that are creating this value and just make sure that they are realistic. Like, for example, yes, they have their product, they're making revenue. Are they aspiring to get to their first 1,000 users? Are they, say, adding another channel? Are they validating the channels they've been using to go to customers and want to double down on one that is more successful for them? Are they testing out a new product or a new market, building on the core clients they have now? So you must be very clear on those milestones. Are they refining who they want to hire in certain key roles? Are they getting some regulation in place and complying for a product that they were testing previously without standardization? So those milestones must be very concrete when you're investing. So those are the metrics on which you're evaluating a business plan.